Have you ever wondered what the true worth of Tesla shares is as an investor in the company? Numerous analysts have estimated the potential value of the firm share throughout the years, but these projections are prone to various uncertainties, chief among them being the stock market's volatility. This price estimate is one you won't want to miss if you're wondering how much Tesla stock is actually worth. As to the current study by Ferguson, a financial services organization, welcome back to Tesla tomorrow, everyone. One of the biggest manufacturers in human history, with the quickest rate of growth, is Tesla. Based on its best estimate of the financial returns Tesla is likely to accomplish, the firm believes in a base case scenario. The investment firm added that although it thinks Tesla stock will hold steady, it does not think the stock market would suddenly agree with these projections, and that Tesla could miss both higher and lower than expected. What do these Tesla price projections mean? Let's find out, but first, please remember to hit the like button, subscribe, and enable notifications if you enjoy this kind of content, so you can stay updated on all things Tesla. Ferguson states that their estimate is based on a base case valuation that falls between 305 and 383. Today's value of Tesla stock includes automobile FSD energy storage. However, it should be emphasized that this scenario does not account for upside optionality related to the new product that Tesla is releasing, which might significantly impact the company's share price, per the reports. The development of Tesla's complete self-driving software aims to enable true autonomy, a significant change that would impact the vehicle's economic value. It was also mentioned that the utility provided to Tesla's consumers might be significantly increased by the humanoid robot known as Optimus, which is presently in the early phases of development. Furthermore, commuters might save time with robot taxis, while the entire addressable, the market is the global labor market as a whole. In a situation where Tesla successfully solves autonomy, the automaker could charge about $50,000 for the software and still get a 100% take rate on FSD, according to Ferguson's assessment. By making these adjustments to the base case previously outlined for the year 2030, it further cited that while it would raise the vehicle's total average selling price to levels that may seem unachievable at first glance, these vehicles would have a drastically higher utilization than personal car ownership, effectively lowering the cost per mile driven. As a result, the firm values Tesla stock at $11.84 per share today. The potential for Tesla to generate recurring revenue as a component of its network is not included in the share value. It was further stated that, in addition to robo-taxis and Optimus, which are the two biggest potential value drivers, there are other factors that could add value and are not included in any of the price scenarios. Tesla needs to use a lot of these products, such as new vehicle types, large-scale virtual power plants, and home HVAC systems, although most analysts and investors tend to ignore this aspect of the company's operations due to its lower revenues and profit margins compared to Tesla's automobile division. The report noted that SolarCity has been offering solar panel installation services to homeowners since its founding in 2006, and that Tesla has historically been perceived as an automotive manufacturer. The Powerwall and Megapack are among the battery energy storage devices developed and manufactured by Tesla Energy. According to these figures, storage revenues are perhaps 10 times bigger than those of the solar industry, and storage margins are probably better than those of solar addressing. Tesla's vehicle division Tesla has declared that it wants to increase volume by 50% annually and sell 20 million units by 2030. This objective was mentioned in the report. According to the company's projections, Tesla will sell 4 million cars by 2025 and 12 million by 2030. Additionally, it predicts a slight drop in Tesla's manufacturing profits from their levels in 2022. Recent price reductions as well as ongoing price reductions throughout time are the cause of this trend. According to Ferguson, the analysis highlights that Tesla is expanding its total addressable market with new model introductions. It also states that the firm will be able to sustain robust growth over the next 10 years with additional Model Y scaling and other new models like the Cybertruck. Even though Tesla's FSD software is an advanced driver assistance system rather than a full autonomy application, its rate of improvement is likely to accelerate, creating a compelling value proposition to drive. It is anticipated that the take rate for this software will increase to 20 in 2025 and 30 in 2030. Additionally, it projects that FSD revenues would reach $16 billion in 2025 and $90 billion in 2030. Regarding Tesla's energy business, the report stated that the company will continue to expand its Powerwall product in addition to Megapack deployments, which are anticipated to be a major driver of growth and profitability. The company also thinks that Tesla's solar roof will keep ramping up, but in comparison to its energy storage predictions, the impact of Tesla Solar is probably a rounding error. Had mentioned Tesla's goal to have 3 TWh of battery capacity by 2030, of which at least 2 will be used for energy storage applications. However, it had also stated that it is doubtful that Tesla can meet this goal because of a major capacity bottleneck in the lithium mining industry. Therefore, its projections imply that by 2030, Tesla will require 1.5 TWh of battery capacity, which would require a significant amount of lithium. According to the report, Tesla was first battery-starved and prioritized its automotive applications above its energy division. The study also claimed that fluctuations in battery supply corresponded precisely to fluctuations in energy income, leading many to conclude that Tesla Energy had no bearing on Tesla's worth. It was also mentioned that margins were far from ideal due to the absence of a reliable supplier and a specialized manufacturing facility. Ferguson added that Tesla's Megapack manufacturing processes are ramping up with a dedicated facility in Lazarop, California, which is capable of manufacturing 40 GWh of Megapacks annually once production hits capacity while addressing Tesla's service margin potential. Ferguson noted that for the first time in its history, Tesla is no longer constrained by access to battery cells. It was observed that while those services and software are crucial in assisting clients in realizing the benefits of their investment in a battery system, their monetary worth will be lower than that of hardware sales. It claimed that traditionally, Tesla Energy's gross margins have been extremely low, which has caused many analysts to overlook this segment of the company's potential. The research concentrated on net margins and earnings before interest, taxes, depreciation, and amortization. The company also thought that over the course of this decade, pricing and margin dynamics would probably alter dramatically, with energy EBITDA margins peaking at about 40 in 2025. It was mentioned that in order to maintain the entire addressable market, Justice's plan to increase Tesla's car production by 50 per year would need selling price reductions. In order to achieve Tesla's tsla scale goals, the energy industry will also need to lower prices. As a result, it is projected that from 2023, storage product prices will drop by 8% year to $270 per kWh by 2030. He also cited the 35 cents per kWh credit at the cell level, claiming that once Tesla reaches 100 kWh scale, these credits from these cells alone will be worth $4.5 billion annually, and that, given Tesla's demand, there is little reason to believe the company will stop ramping domestically once the facility is built out. Prospects, according to the company, Tesla is not the only one who believes the energy storage business is going to grow rapidly. It went on to say that it thinks industry observers will keep raising their expectations for future demand, and that the companies who can quickly scale up capacity would come out on top. However, the research also pointed out that there are serious risks connected to Tesla's ambitious ramp, and that the carmaker might not expand to the levels it has projected for its base case. It further stated that a share value of $159 is predicted if Tesla's energy storage deployments only reach 300 GWh by 2030 and car sales only reach 8 million units with no increase in the FSD take rate price. This figure could potentially be even lower if the margin assumptions are revised downward, but overall, Halter Ferguson anticipates that Tesla will keep offering services and software for energy management to assist users get the most out of their solar and energy storage systems. The company said that if Tesla keeps demonstrating great execution, Halters, it will modify its projections as it gains more trust in the company's ability to mine lithium or employ sodium-ion batteries. According to Ferguson's assessment, Tesla continues to be rated as the investment with the strongest conviction at this time due to the discrepancy between its base case and the company's recent share price, as well as the high upside return potential of the AI and bot scenarios. What are your thoughts with the most current Halter Ferguson report? Please share your thoughts in the space provided below. If you'd like to learn more about Tesla's recent activities, click the following video to view it on your screen. Talk to you there.